With the Federal Reserve announcing their first interest rate cut about 2 weeks ago, I've started becoming more bullish on one asset class in particular. Now, when interest rates do get cut, it's overall a beneficial thing for the majority of sectors. I recently discussed this topic in a video last week. But there's one group of investments that have performed pretty poorly from a share price perspective for more than 2 years. But now that rates have finally been cut, and Jerome Powell has indicated that more cuts are likely later this year, this has set up fixed income investments to finally start performing better in the market. More specifically, I've been investing thousands of dollars over the past few weeks into closed-end funds that hold these fixed income investments. The investments I've been buying more aggressively since rates have been cut are all by PIMCO, which are PDI, PTY, and PCM. All three funds hold various forms of fixed debt, with each fund typically focusing on one kind in particular. High current income is the main objective for each of these funds, with capital appreciation as their secondary objective. PDI, or the Dynamic Income Fund, invests up to 25% of its portfolio into privately issued mortgage-related investments. PTY, which is their Corporate and Income Opportunity Fund, invests a maximum of 25% of its total assets in non-US dollar denominated securities and a maximum of 40% of its total assets in securities of issuers located in emerging market countries. The PCM fund holds a mixture of mortgage assets, high-yield corporate debt, and to a lesser extent, other assets with varying maturity dates. If we compare the assets of these funds side by side with each other, you'll see they hold various forms of debt, including corporate debt, emerging market debt, municipals, commercial and residential MBSs, as well as options-based investments. The vast majority of what these funds hold are located in the US, but there is some international representation here. All three of these funds have been struggling ever since interest rates started rising. You can see here that with PDI, it was a really well-performing fund for about a decade. It offered some share price growth and a steady high dividend. Things got derailed during the pandemic, and then you can see that during the recovery, the Fed started increasing interest rates. This threw a wet blanket on their share price recovery, and like I mentioned, investors became less interested in these kinds of fixed assets that are inside of these closed-end funds. PTY is in a very similar situation. For over 20 years, this fund has been a really reliable source of monthly income. It survived the financial crisis and eventually soared to almost an all-time high back in 2021. But again, its price and NAV fell pretty significantly when interest rates started soaring. I think it's important to bring up the fact that none of these three funds, despite their falling share prices and net asset values, have had to cut their dividends since interest rates started going up. PDI has never reduced its dividend in its 12-year history. PTY's dividend history has varied, but today it pays about 1.5 cents less than it did 21 years ago. PCM is also in a similar situation to PTY. It also pays about 1.5 cents less than it did back when it launched in 1994. These dividend histories are unmatched by almost every other closed-end fund you can find in the market. This is what can make these kinds of investments ideal for both retirees and those who just love a steady cash flow paying investment. Although it's rare for closed-end funds to offer any significant dividend growth or substantial share price growth, one thing they can offer are really high monthly dividends. I recommend these kind of funds to people who need the retirement income or just want the income today and are comfortable bearing some risk. Despite their incredible dividend histories, what these funds hold are considered higher risk investments. High-yield corporate debt by nature is riskier than lower-yielding debt because the higher-yielding debt comes with a lower credit rating. This means that this kind of debt is much more likely to default than the lower-yielding stuff, and so what these issuers have to do is they have to offer a higher yield on this debt to attract investors. A fund that holds lower risk investments wouldn't be able to offer such a high dividend yield that these funds offer. As I've also mentioned in previous videos, a lot of what's inside these funds are kind of a black box in that they're very difficult to analyze. They do hold some publicly traded companies that have financial statements that anybody can read, but they also hold bonds issued in foreign countries. It's incredibly difficult, if not impossible, to perform an analysis on everything that's inside these funds. And some other funds by PIMCO have gone through much more substantial dividend cuts. But PDI, PTY, and PCM just have some of the best track records by this company. The fact that both PTY and PCM made it through the financial crisis without a significant cut speaks to how great the managers at PIMCO are. I know it probably sounds like I'm sponsored by this company, but I'm honestly not. I've just been a fan of their great track record, and somehow they've been really successful at picking good investments to go in their funds. So while we've looked at a lot of good stuff, let's now look at the biggest downside to buying these CEFs right now. And it's something that people regularly point out and criticize, which I think is fair to a certain degree. All three of these funds are currently trading at pretty large premiums, which is an issue that's unique to closed-end funds and not ETFs or open-end mutual funds. In addition to having a fixed number of shares available, a CEF can trade at a premium or a discount to the value of everything that's inside the fund. So if you buy into a CEF that's currently trading at a premium, you're basically paying more for everything that's inside of it. When it comes to normal stock investing, many investors won't consider buying something that's overvalued, let alone at the valuations that these funds are currently trading at. Right now, PDI is currently trading for about a 19.5% premium. PTY is trading at a 24% premium, and PCM is the worst of the bunch at an almost 26% premium. In the case of both PTY and PCM, they're both trading well below their 52-week average. You can see PCM once traded for a 43% premium over the last year. But as I pointed out earlier this week, when it comes to higher quality investments, you will most likely have to pay a premium price to enter them. And as I've shown in the past, and I'll show you right now, that doesn't mean you shouldn't consider investing in something. Even when a stock or a fund is trading at a sizable premium, it can still lead to a very profitable investment. In the example of Main Street Capital, this is a stock that's always traded for a very high premium. In the past decade, there's only been a few days where it was trading at a discount. But it's been such a great stock, and even if you bought it when it was overpriced, you'd still be looking at great returns. Let's assume you bought into Main Street Capital 10 years ago when it was still considered overvalued just like today. Using our DRIP calculator, a $10,000 purchase into Main Street Capital 10 years ago would leave you with a total return of 275.11%. That comes out to roughly an average yearly return of 14.13%, which beats the S&P 500. Your $10,000 investment would now be worth $37,524. So you can see that investing in overvalued stocks and funds can still lead to good returns. If you waited until it was discounted, you would have been waiting a very long time. So in the case of these closed-end funds, everyone will need to decide for themselves if they're worth paying a high premium for. For me personally, because I love a high monthly dividend that's very, very consistent, it's definitely worth paying a premium to me. So in summary, now that it seems clear that the worst is behind us when it comes to interest rates, I've been betting that things are going to improve much more for these investments. With rates going down, this should mean a recovery in their NAVs, and share prices should react positively to this. It's already been happening, as PDI, for example, is already up sizably since late August. PTY and PCM have also seen smaller amounts of growth, but things have been looking more positive for these funds too. Even though they are trading at high premiums, they're still offering high yields. PDI and PCM are yielding around 12%, and PTY yields almost 10%. So ultimately, even at the prices that I'm paying, I still view these funds as being worth it because I'm getting a 12% yield on my money. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.